Welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, President and Chief Investment Officer. In this podcast, we ignore all the noise and have conversations about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. And we're recording this podcast on September 17th. Thanks for joining us. We're going to get into talking about Brookfield's Investor Day. They seem to have one every single year, right?
They do.
We learn a lot every time we listen to the Brookfield management team. They're the most bullish guys on their own stock, and I think for good reason, and they certainly got the track record to back it up. Ernest will also talk a little bit about Adobe's earnings. That stock's has been a disappointment, but we'll tell you why we're sticking with it. And we did a podcast on that a few weeks ago as well. And whatever else we come up with. Before we get into that, let's get into this. If you like this podcast, please subscribe to it on Apple, on Spotify, and YouTube. We really, really love your 5-star reviews. It helps so much growing this podcast. So if you haven't had a chance to give us a 5-star review, please do so. We always love your comments, your feedback. Feel free to reach out to us. And of course, if you have any interest in Baskin Wealth Management Services, feel free to contact us. You may even get to talk to Ernest about your favorite stocks. So with that, Ernest, you're doing okay?
Feels like, sometimes you go to a restaurant and they say, if you give us a 5-star review, then we'll give you a free appetizer.
Yeah. Hey, we'll give you we'll give you nice smiles. If you send us your 5-star review and proof, maybe we'll give you a shout out on the podcast. How's that?
Okay, that sounds good to me.
And I think we haven't done the mailbag in a while, so we'll be doing one of those episodes very, very shortly. We're happy that we're back on track. The school year has started. The university year has started. September markets surprisingly strong so far. Today, both the United States and Canada cut interest rates by 0.25%. That was expected, right? The markets thought that was a done deal. We'll see how that plays out over the next year or so. It's clear, this is not economics politics, a podcast, but it's clear that some of the economic numbers are getting weaker after the big growth coming out of the pullback of 2022.
Yeah, so there was a stat that I saw that even though the markets, the S&P 500 especially, is at an all-time high, 40% of the index is actually negative year to date. And so
that's because 40% of the index is like 7 stocks or 10 stocks.
But
I'm just saying 40% of the S&P index is 10 stocks.
Yes.
And the remaining 493 or whatever represents 60%, and 40% of the entirety of the S&P 500 is of the stocks are down. So about 200 stocks.
Yes, about 200 stocks.
Yeah.
So, and to your point, there's a lot of subsectors in the U.S. that are just not doing very well. Like there's alcohol, like restaurants, biotechs,
for sure,
home builders, you can. Each of these has maybe some of their own things that are going on with them.
Yeah.
But I think the hope is that if interest rates are, starting to fall a little bit, maybe for something like home builders, people will start moving again, activity will pick up and maybe bring some life to the remaining 493.
Correct. And the S&P 500 is a portfolio. Our clients have portfolios also. What one should care about is not that there's 40% of them down. You should care about, are you making money?
Yep.
And is the portfolio going up? The problem childs, they'll take care of themselves if you own good companies.
Yep.
If you don't, then hopefully your active portfolio manager will take care of it for you. But we always have to remember that portfolio management means you own a portfolio. And it's very important to remember when you have a portfolio of 30 to 35 stocks, not every one of them is going to go up in any one year. In fact, if they do, you're not well diversified, right? If you own a portfolio of 30 stocks and every single one went up at the exact same time,
Yes.
I guess you'd feel good that year, but ultimately, they all can go down too. So when we construct portfolios to limit risk, right? To try and preserve capital. That means we own more stocks than other portfolio managers. We also equal weight positions. We try to limit position sizing to the upside to protect capital. I mean, sometimes those things work in any one year, sometimes they don't. But portfolio management to us is what matters is the long-term return of your portfolio, not how it's done today, yesterday, 6 months ago. And of course, if you had good returns up to today, good for you. What matters is what your returns are going to be like going forward. And we're hopeful that the combination of the types of companies we have will generate good returns. We look to own companies. Ernest put it great in one of our recent blogs about AI. Companies that have durable moats, companies that have competitive advantages, companies that can reinvest cash flows at high returns, companies that have management that have been through lots of problems and know how to adjust. And I urge everybody to check out Ernest's latest blog on AI. We share our thoughts, whether it's in a bubble. I think, spoiler alert, some of it is. But I also think that the companies that we own in our portfolios, some of the Mag 7 names, are making so much money on their core businesses that they'd be silly not to invest in AI if it really turns out to be an absolutely transformational business opportunity.
Well said.
Okay, so speaking of a company that's very excited about AI,
Yes.
Brookfield and Brookfield Asset Management. Long-term clients will know that we've owned shares of Brookfield, I think, since early 2000s, so quite a long time. The clients received shares of Brookfield Asset Management, I believe, in 2021 or 2022. I can't remember the exact.
It was 22, late 22.
So stock didn't work as soon as they spun it off, but had you held the shares since, I think, over the last 30 years, I think Brookfield is saying that with dividends reinvested, their shares have compounded at 19% a year.
Yep.
Sounds good to me. So every year in September, Brookfield and its affiliates host an investor day. We tried actually to go in person, right?
We weren't able to this year, but they do host multiple investor days. So the Brookfield Corporation one is after the Brookfield Asset Management one, and then the affiliates, which would be Brookfield Infrastructure, Brookfield Renewables, and so on, those are held on a separate day.
Okay. So you listened to the whole thing.
Yes.
You read there was a lot of charts that Brookfield and Brookfield Asset Management printed out. They also went on an interview. There was a number of interviews of Bruce Flatt across media and in the newspaper. So the stock is at an all-time high today, give or take. So clearly what they said was really positive. I think there's a lot of positive tailwinds for the Brookfield story right now. Things seem to work in their favor, although they'll always tell you that no matter what environment it is, things always work in their favor. When things are bad, they have the liquidity and the cash flow to buy buy assets that are distressed. When things are wonderful, well, then there's not much to do. So Ernest, I'll kick it over to you and we can review the Brookfield and Brookfield Asset Management Investor Days.
Now, Brookfield holds investor days every year. And so I think it's more useful to look at what's being added to the story. What are they saying that's new to the business rather than looking at, because a lot of it is basically repeating the same stuff that they've talked about for a long time.
Yeah. And that's still important. There's always going to be new people finding out the story to Brookfield, new investors.
Yep.
It's always very good to reinforce what your message is, remind people what your long-term goals are. Brookfield is excellent at that. They're excellent communicators, but you're absolutely right. What matters is, did they say anything new that's additive, that is thesis changing to the upside or to the downside, right?
And so for the asset management business, this is the one with ticker BAM.
BAM.
And this is the one that manages money for investors. It's an asset-light business. All they do is they take other people's money, some of which is Brookfield. They take it from institutional investors, and then they have these. They package the money together in funds that they sell.
So they have a whole bunch of different investment funds or private equity funds or limited partnerships.
Yep.
Where they'll make a fee, management fee.
Yep, they earn management fees.
And also charge a performance fee based on returns of the fund over its life.
Yeah.
Okay.
And so for this business, I think the big story here is that they want to focus, well, first of all, like any good asset manager, they are very excited about the opportunities with AI, right? Not necessarily just because they think AI will be transformational or not, but because this is an opportunity for them to go out and raise some more money. And so they are doing that. They launched a new fund called the AI Infrastructure Fund, which they are actively marketing today. And they think that this represents another opportunity for growth for fundraising going forward.
Yeah.
So that's kind of the first thing that they spent a little bit of time talking about. And AI fits right into their core competencies, so to speak, because they are very experienced with data centers. They've operated data centers for a long time. They're experts in infrastructure, such as natural gas, electricity, pipelines, these kinds of things, which are becoming increasingly important in terms of powering up these data centers. And so to be able to put this all together into a product to market to investors and earn fees on, I think they're very excited about that.
Quickly explain to those that don't know what we're talking about. What is a data center? Why would someone build it? What goes into a data center? Why are we building them like crazy? Why are they so important to the economy and AI going forward?
Yeah, so data center is basically a building that has servers inside. That is, whenever you are, let's say, watching Netflix, right? The way that it works is that you're basically connecting through the internet to a data center where Netflix has its data stored. This is usually co-located together with the other servers, but
so there's not just Netflix in there.
Yeah.
There's Netflix, there's Amazon, there's
Yeah.
Oracle, there's
Yeah.
Uber.
And so as we move into a world with AI, most of the computing for AI, so when you submit a query on ChatGPT, for instance, that is being processed within a data center through basically AI chips, which are made by NVIDIA. And so a lot of the CapEx that's being spent by the hyperscalers, the big techs, that's going into data centers to be able to do these calculations that are required for AI.
So there's two types of data centers. You can build one on your own for your own needs, right?
Yeah.
If Baskin becomes an AI company and we want to, I don't know, create AI data and what have you, we'll build our own data center and just use it for us.
Yeah.
Or you can build a data center and rent out racks on the server to Netflix and Amazon and those kind of things.
Yeah, there's a lot of different models.
So it's like a real estate.
In some models, you basically just provide the building and the other guys, the customer provides their racks.
Yeah.
In some, it's an entire solution. But basically, Brookfield thinks that there's an opportunity to go out and operate and own data centers on behalf of its customers. And so some of the target customers that they're thinking about are governments and enterprises, where lately there's a topic of something called sovereign AI, where companies have whole countries are providing AI data center capacity within their countries so that it doesn't have to be sent somewhere else as a matter of national security. And so that's one area that they are investing in.
Just to get on a tangent here, of course, lots of governments are still using legacy software that may be installed on their own computers, not even accessing the cloud or AI. There's still a big potential, like Amazon will tell you, forget AI right now, there's still big potential of moving data that's held in legacy servers at offices, at warehouses, to the cloud.
Yes.
And that's globally. So pretty exciting times, even without AI.
And then I think one other benefit for somebody like Brookfield is that they are marketing this as a real estate product. Whereas if you look at the big techs, and this has been some of the worries about the stock, is that these are historically extremely profitable, high return on invested capital businesses that are, and there's been a worry that the capital that they're investing into data centers is a lower return activity. So to the extent that somebody like Brookfield can come in and accept a lower return on behalf of its customers, that's another trend that benefits Brookfield as well.
Yeah. And Brookfield wouldn't be building these unless they thought they could earn decent returns.
Well, that was one of the topics that was addressed in the call, where somebody said, well, what if this whole thing blows up, right? Because everybody's investing in data centers today. And I think Brookfield's response was, well, you have to keep in mind that we're not building these things on a speculative basis. These are very long-term, 10, 20-year contracts that we have with very, very credit-worthy counterparties. So
you can imagine who they are.
Yeah. So it's possible that the industry goes into, has overbuilt capacity, but it's not an issue for us.
Right now, what I read is the capacity at data centers is close to 99%.
Right.
So there's not a lot of room for any data centers to accept customers, let alone a large one. And those that are building out data centers for the next keep in mind, it doesn't take 2 minutes to build a data center. It takes a number of years, and you have to order the products and so on and so forth. We're reading now that companies that are looking to build data centers are already signing up customers and are sold out based on their capacity that they haven't even built yet. So this is how large these demands are. And this is before AI is really taken off, right? It's still in its infancy. I don't think my parents have ever used ChatGPT. Maybe they never will, but I assume that there's billions of people and millions of businesses that still haven't used AI yet.
Yep.
And of course, as the technology improves, there'll be more needs for better data, better chips, you name it. So it's going to be pretty interesting. So getting back to Brookfield.
Yeah, but getting back to Brookfield, so that's one opportunity for them to raise more money and earn fees on.
Yeah.
Another thing that they've spent a lot of time talking about, and not just Brookfield, but the entire alternatives industry, is selling to individual investors. Because historically, the large bulk of assets that are managed by Brookfield were from institutional investors. So think of pensions, family offices, these kinds of investors. And Brookfield wants to, like any good asset manager, they want to raise more money, and that includes being able to raise money from individual investors.
It's a multi-trillion-dollar opportunity, and legitimized by Donald Trump, who wants to open up 401ks to private equity investments. That may come here to Canada too for RSPs and TFSAs. We'll see. We've talked about alternatives. I don't want to get into our love or hate for them, but these guys are not in the storage business. They're in the moving business. They're in the fees business. If there's a trend that needs to be the one wants to be on top of, I think Brookfield is always at the cusp of those trends.
Well, and I think they should.
Yeah.
Their job is to make money, and that's what they're doing.
Exactly.
So that's a major growth opportunity for them. And then I think the last aspect that hasn't really been talked about as much is that at the time of the spinoff from Brookfield Corporation, there was an agreement between BAM and Brookfield Corp that all of the carried interest, which is the performance fees on the funds that they were charging, would go to Brookfield Corp. But that after the spinoff, 2/3 would go to Brookfield Asset Management. And so
still a good deal for Brookfield Corporation.
Yes.
They're going to get 1/3 of the performance fee.
Yes.
For doing what exactly? Being the parent of the...
Yes, for being the parent.
It's always good to be the king. Yeah.
But starting in 2030, which is still a couple of years away, but starting in 2030, the funds that Brookfield raised after the spin will start maturing and start earning performance fees. And so that will be a more meaningful contributor going forward as well.
Very interesting. So Brookfield obviously very bullish on their future.
Yeah.
They spent a lot of time, telling everybody how great they are, and we told you we would do this, and we did it.
Yep.
We told you that our assets would double over 5 years. We told you that if that happens, our stock price would double, and that's absolutely been the case. They're setting, once again, Ernest, extremely ambitious targets for the next 5 years. Some of it is predicated, of course, on AI, predicated on opening up private equity to retail investors. But they're also getting into kind of like a Berkshire Hathaway type approach, right?
Yeah. Yeah. And this brings us to Brookfield Corporation, where the key driver of results going forward for Brookfield Corp is their insurance business. And so this is a new business for them, not like that they started in 2021, where, and the way that this works is that Brookfield Corporation or Brookfield is going to go out and write annuities. So annuities are essentially a fixed income product that retirees will purchase, and you earn, say, 3, 4, 5%.
Yeah.
Forever.
Annuities are generally for low risk investors.
Yeah.
And essentially what you do is you invest, call it $250,000, and the company that you invest with promises to pay you a percentage each year.
Yep.
For the rest of your life.
Yes.
But you won't get the principal back.
Right.
So if you're going to buy an annuity, make sure you get a high interest rate and you live a long time.
And so from Brookfield's perspective, these annuities represent an investment opportunity because they have they get the $250,000 up front. They have to pay a stream of interest.
Let's call it 5%.
5%.
Yeah.
But then they get to use that $250,000 almost however they want to, and keep the return minus the cost that they have to pay.
So what are they doing with that 250? Are they investing in their new funds? Are they using it to buy other companies? Same.
So it's an extremely regulated market because the regulator wants to make sure that you're still able to pay the policyholder or the annuity holder what you promised them.
Yeah. So if that person buys an annuity when they're 65 years old and they live to 95, you got to pay them 5% of $250,000 a year for 30 years.
Yes.
Yeah.
And so it's very regulated. Most of this is invested in fixed income, which is managed by Brookfield Asset Management because they have a very large, they have Oaktree, which is one of the largest credit managers in the world. But this is a very profitable business for Brookfield because they are able to capture the spread from what they're earning on high yield or credit investments and what they're paying out to annuity holders. And that spread is about 2%. Mm-hmm. And on top of that, they're able to lever up their balance sheet about 7 to 8 times. So they get about 15 to 20% return on equities.
Financial engineering at its greatest.
And I think there's a variety of very attractive aspects of this insurance business to Brookfield. I think the first one being it grows Brookfield Asset Management. They're getting roughly, I want to say $25 to $30 billion. They're writing $25 to $30 billion of annuities every year.
Yep.
This is directly going into Brookfield Asset Management that is invested at Oaktree and their various fixed income funds and earning fees. Oh, well, not in the same way, but they're earning fees.
Well, there's a potential to earn a performance fee on top of that, right? If they reach a certain high water mark, whatever that is, right? If they achieve more than 8%, they'll take 10 or 20% of the upside from that. Yeah, for example.
And then Brookfield earns the spread. So it's another step up. It allows Brookfield to lever up the balance sheet because these are very long, very predictable liabilities. And overall, it's probably the largest growth opportunity that they have to increase returns.
There are risks, of course.
Yes.
They could
Yes.
make poor investments. The economy could stink. All their annuity holders could live way longer than they expect.
Yes, this has happened many times in the
Yes,
past.
yes. So prudent underwriting is important. Brookfield didn't come up with this business out of thin air. It purchased a number of insurance companies.
Yes.
It has expertise in writing insurance. It hired experts to write insurance, to actuaries. Insurance can be a risky game. It can blow up once in a while, but I think what Brookfield is doing, unlike writing life insurance or property and casualty insurance, these annuities are very, very long lives. And so there's a long time for it to make the returns more than what it has to pay to its customer that owns the annuity.
Right. I think ultimately it has to do with properly matching the balance sheet and ensuring that you have expertise in how you're managing the portfolio. Because if you look at, there's been many examples of this where life insurance companies or annuity providers blew up because maybe they took too many risks, or maybe they wrote too many annuities at high interest rates and then interest rates fell. So this is something that it's profitable if you do correctly, as you can see with somebody like Berkshire Hathaway or Markel, where in essence they're able to lever up the returns on the investments they make by using insurance float, but then you have to do it in a way to prevent yourself from blowing up.
So how big does Brookfield think its insurance business can get to?
Yep. So they're targeting they just made an acquisition in the UK called Just Group, which does pension risk transfer. So essentially the same thing in that you're assuming the pension obligations of, whoever is offering pensions.
Yeah.
And it's a long-lived, predictable liability, but then you're able to invest the assets. So they've been moving more into the institutional space. They're looking for opportunities to go into the P&C insurance space, property and casualty space, which I think allows them a little bit more flexibility with how they invest the float. And so put together, I think they are targeting $30 to $35 billion of premiums every year, or insurance assets. And hopefully this is going to reach about $350 billion of insurance assets by 2030.
So by 2030.
Yes.
And so if they're going to earn a 2% spread on that $350 billion of assets, that's a revenue stream of $7 billion.
Five, six-ish. Yeah.
Okay, yeah. I just threw out the 2%, but could be a little less than 2%.
So that's what the target that they have.
Yeah. And that's creating money out of thin air, so to speak, right?
Yes.
This is not a revenue stream that Brookfield had 3 to 5 years ago.
Right.
And if done successfully, this could be the biggest part of their business.
Right.
Yeah.
And so that's
an exciting
something that's going
opportunity.
to benefit Brookfield. It's going to benefit Brookfield Asset Management because they're going to have more assets to manage, and it's going to enhance the returns overall as well.
Yeah. I assume that writing annuities is a competitive business.
Yes. They're not the only ones doing this.
It's a commodity business. What makes them, are they bullish on their underwriting skills, on their ability to acquire? I mean, what is the secret sauce that Brookfield may have to grow its insurance business over Barry and Ernest's insurance, or Barry and Ernest's annuity business?
I think it has less to do with a secret sauce in terms of underwriting annuities, because in the end of the day, annuities are a commodity.
Yeah.
You're going to shop around for the best
rate. Yeah.
I think the real competitive advantage, so to speak, is around the investment ability, because Oaktree is really one of the premier fixed income managers that exist.
Yeah.
And so by having that ability to earn like attractive returns in fixed income, that allows you more confidence to be able to write annuities and add assets that way.
So summing it up, essentially Brookfield thinks they can earn a better spread than some of their competitors.
Yes.
Because they have in-house investment management.
Yes, and keep in mind that a large chunk of the insurance industry today is not, and Brookfield made this point very clearly in their investor day, they're not managed using this model. They mostly maintain a balance sheet of cash and liquid credit, where they're not really trying to maximize the spread that they're earning on their investments. They're just trying to match the duration where their primary business is writing the annuities. So increasingly over time, I think these type of operations are going to get acquired by firms like Brookfield because they are able to earn better returns.
Sounds very interesting. Okay, so we talked about the new business, the insurance. We talked about the take rates of how much they're going to get from these performance fees. One of the things that's obviously important is, as you mentioned, a lot of these funds are eventually going to start paying performance fees. Unlike let's say a hedge fund that you buy, and it does very well each year, the hedge fund collects the performance fee if you have good returns. Brookfield doesn't collect the performance fees until it reaches a certain lifetime of a fund, right? 7 years, 8 years, right? Is that how it works?
Right. And this is how it differs maybe from some of the other alternative products that we've talked about on this podcast, in that these are not even what is considered semi-liquid. Like, you actually cannot take your money out of these funds until the fund is complete. So I think the carried interest, and every year they provide a figure for this. Every year, about how much carried interest that they expect to receive over the next little while.
That's based on the performance of the fund.
Yeah. And so if you look at the performance of the funds that are maturing right now, the carried interest is almost certainly going to be achieved because the funds are nearing the end of their life. A lot of the assets have already been monetized. So there is no risk that they're not able to, realize the performance.
So essentially what happens is when the life of the fund is over, they settle up. Here's my take. Here's your take. Everybody's happy. Very, very fascinating. So let's talk about the part of the business that everybody was worried about a few years ago, which was the real estate business. In 2022, we saw interest rates spike higher as a result of supply-led inflation due to the pandemic. And we saw, real estate, anything to do with interest-sensitives, especially real estate, getting absolutely crushed. Brookfield had to bring back some of its real estate in-house. It had to reorganize a lot of its real estate. It called some of it trophy real estate, some of it transitional, which means it's caca and they want to get rid of it at some point. That's the truth. But things have been improving with real estate because no one's building. I mean, we see people building condos and stuff, but I don't think there's new offices being built in years.
Yeah, I think the bet for Brookfield when they acquired Brookfield property was that they actually thought they were buying cheap because they bought it at a meaningful discount to net asset value. It hasn't worked out quite as well as they'd probably hoped it would be. But I think you're right in that. I think you said it well. Real estate fundamentals, especially for the assets that Brookfield owns, which are office and retail, those are performing very well. Those are performing better.
The trophy stuff is performing well.
Yes.
Yeah. The great quality assets that it owns. Yeah.
So if they had a lot of detail about this, where if you look at office space in Toronto and New York and in Hong Kong and Singapore and in London, despite what you might hear about work from home, right? Office occupancy is at 99%. Like, companies want employees to go back to work.
Yeah.
Rents are going up.
Yes.
And more importantly, no one's building new office buildings.
Bang on. We just re-signed a lease here at our office space at Yonge and St. Clair. I can tell you, we're not paying less than what we paid 10 years ago. So, and I can tell you that, when we looked around at other buildings, prices have gone up. So it's very, very interesting. Even though people are working from home, more and more are coming back to the office. More companies are forcing people to come back to the office now, or saying, you got to work 4 or 5 times a week. Population growing, the economy's growing, and the supply is non-existent.
Yep. And so that's true for retail as well.
Yeah.
Where I think if you look at retail occupancy levels, and especially the supply of new retail space, again, like there's not many new malls being built. People are tearing them down.
Yeah.
whereas retailers are increasingly still reliant on the store as a way to grow traffic. So basically, like, and some of this is Brookfield obviously wanting to talk their portfolio up.
We all do. Yeah.
But
Yeah.
I think the big picture is that the worries about their portfolio are largely unfounded. Interest rates are coming down and hopefully maybe even more, as we saw with the rate announcement that just happened as we were recording this podcast.
Yep.
And they plan to reduce their balance sheet investment to real estate going forward.
Anything else to add on the Brookfield investor? Anything additive that you learned?
So I think the one thing that we didn't really talk about with insurance was how this transforms Brookfield Asset Management. Because in asset management firms, what everybody ultimately wants is permanent capital, right? Capital that cannot leave your firm and that you can continue to earn fees on. At Baskin Wealth, we have, like, I would consider the assets that we manage to be long-term capital, but our clients can pack up and move to another firm.
Yes. Right? And they also, many of them are retirees. They have
Yes.
they need their capital to live off of. So we can't tell them, sorry, you can't have your capital back in 30, 60, 90 days or in the next 3 to 5 years. You can have it back when you need it. But yeah, so that's a good point.
And at Brookfield Asset Management, historically, most of their capital has been either in long-term funds, so the funds that they manage for 10 years or whatever, or permanent capital through the affiliates. So these would be Brookfield Infrastructure, where they raise some equity capital to list the thing on the stock exchange. If you sell the stock, like, they're still managing the money. So this generates a perpetual stream of fees for Brookfield.
Yeah, people need to understand that Brookfield, through some of these listed affiliates, charges a management fee based on the size of the share, size of the market cap, right?
Yeah.
Obviously, if the market cap goes up, they'll make more fees. Market cap goes down, they'll make less fees, but they're looking to grow those, so they have incentives to grow. And obviously, everybody wins when the stock price goes up. The customer, the client who owns the shares is going to be happy if their stock price goes up, and Brookfield will be happy because they make a higher management fee.
And as they increase the management of these insurance assets, these are permanent capital. Mm-hmm. The annuity holder, under most circumstances, cannot decide, I don't want this anymore.
No, you're stuck.
Yep.
Once you've signed up with an annuity, whatever the amount, I mean, it's nearly impossible to get your capital back.
Yep. And so there will be a shift in the mix of the assets that Brookfield Asset Management is managing to more permanent capital, and which I think deserves a higher valuation, because this is money that is going to earn fees basically forever.
Yeah, it's permanent capital less what it owes.
Yes.
To the annuity holder over the lifetime of the annuity. No one knows how long someone's going to live.
And that's Brookfield Corporation's problem.
Yeah.
They're just the asset manager, right?
Yeah.
So
Brookfield Asset Management is actually more attractive with these with the permanent capital insurance than Brookfield itself. Interesting.
Which I think, maybe to kind of conclude this segment, for the longest time, I think we've always said that we like Brookfield Corporation more than Brookfield Asset Management, because you get the benefit of the compounding, right? Brookfield Asset Management pays a dividend, but then Brookfield Corporation, they're reinvesting their cash flows, so you get that compounding benefit over time. But I actually kind of like Brookfield Asset Management now, because you're getting the benefit of all the insurance on an asset-light basis. They're managing the money for Brookfield Corp. It's asset-light, so you're not taking any balance sheet risk. And you're starting to get carry starting in 2030. So it doesn't seem like too bad of a deal to me.
Very nice.
But that's...
Well, luckily, we own both. Yeah. And so, okay, so we'll move off from Brookfield. Let's quickly talk about Adobe. We did a podcast a few weeks ago. I think we called it Adobe, a creative compounder. Hope you can check that one out. Compounding.
I didn't even realize that, what the name, until you said that.
Yeah, it's pretty cute, right?
Okay.
Yeah. So compounding of cash flows is something Adobe's great at. The stock price compounding recently, Adobe's been not rewarded for the great results. And we've talked about this so many times already. The results from Adobe since we purchased the stock have actually exceeded our expectations. Ernest mentioned, I think you mentioned in one of your blogs or to the portfolio managers that it's the only company we have in our portfolio that's, I think, growing faster
Growing
than,
double digits,
yeah.
but trading below the market.
Yeah. So that's pretty weird, right?
Yes.
Adobe recognizes that its stock is significantly undervalued. Adobe's been buying back stock hand over fist. Adobe, unlike Amazon or Meta, doesn't have to build out data centers. Maybe that's a detriment. I don't know. But for now, Adobe is just generating so much free cash flow. And so the worry for Adobe that is all these new, we'll call them generative AI products.
Yep.
People will be using them instead of using Adobe or paying for Adobe, and they'll be using them to create content, edit the content. It will be a lot cheaper. They'll just tell the AI what to do, and Adobe's is going to be disrupted. We've looked at the data recently. There's no evidence that that's happening. In fact, Adobe keeps on raising its guidance. No question, Adobe it's facing a lot of competition on a lot of different angles, as is every company. But the fundamental results have been very, very strong. Do you think Adobe's stock has performed in the last few months okay? It just can't seem to find a catalyst to go higher, even when it reports good fundamental numbers. So your take on Adobe, and do you think the risks are warranted? Do you think or even if the risks are warranted, do you think that the pullback in the shares or the valuation is too cheap given the risks?
Well, I don't really have an opinion too much on when sentiment is going to turn.
You don't? I don't either.
I think these are those things where you just kind of have to let it play out, because as we saw with Google a couple months ago, everyone hates it until they don't, right? So like the market is going to do what it does to the company. But then what I pay attention to is what they're actually doing and how they are, pivoting or adapting to the times.
Yeah.
I think they're making good progress because, first of all, financial results are good. There's no evidence at all so far that there is a mass layoff or cancellations due to AI.
Mm-hmm.
So that's the first thing. I think the more important thing is that Adobe is what we call a software as a service company, SaaS company, which means that the users are paying a monthly subscription fee to access their products like Photoshop through the internet. And the key metric for SaaS companies is retention. Because if you have a customer that is going to pay, let's say, $20 a month for forever, right? The longer you can keep that customer subscribing, the better your overall business will be, because you don't have to go out and attract new customers to come in and replace that customer. So your whole business is just that much more profitable if you are improving retention.
If you're able
to keep your customer. And with regards to AI, I thought it was very encouraging this quarter that there were two things that happened. Number one is that they had created a new pricing tier for called Creative Cloud Pro for their AI related products.
Okay.
And this includes a new I'll get into this later, but it includes a new app that they have called Firefly.
Okay.
So number one is that they saw what Adobe is seeing is that Creative Cloud Pro, so the new AI tier, is attracting new customers.
Okay.
So it's making more people sign up. And more importantly is that people who use Adobe's AI tools are retaining better. So they're canceling their subscriptions less.
And are they paying more? Obviously,
and
you're paying more.
And they're paying more for this tier as well. So on the traditional metrics of a SaaS business that we would evaluate Adobe on, AI has been a positive for the business. I think that Adobe's position in AI is also very interesting through this Firefly app, because what Firefly is that it's basically a playground that you can experiment with different AI models with. And the benefit of that is that you can, through one interface, you can play with all the different AI models that exist out there. So Nano Banana is kind of the
Sora, Midjourney. Yeah.
And that is immediately editable through Photoshop within the Firefly app.
Yeah.
So I think what Adobe is doing is positioning themselves kind of as a third party, well, not exactly neutral, but a neutral third party where creators can use AI to actually help them accomplish the goals that they are.
And one of the big problems with AI, of course, is stealing copyright, using images that don't belong to you, because like AI will come up or make up anything it wants, right? And so if you're doing work for large customers, you always say Nike, for example.
Yeah.
They don't want to be sued.
Yeah.
So AI, Adobe is really the only company that can provide a safe environment for people to create and edit. Pretty much, right? Is that a good explanation?
And I think that's an important point, because one of the misunderstandings that I often find about Adobe is that it is largely an enterprise software business. They do sell software to, the individual photographer or those people, but by and large, most of their revenue is coming from enterprise accounts. So these are people that are marketing departments within Nike or within large companies that are using Adobe tools as to make ads, right?
So yeah.
And so the reason that this is important is because what enterprises care about is, number one, ensuring that, they're not getting sued by the marketing materials that they push out.
Yep.
But more importantly is that they use Adobe tools not just to make the ad, but as part of an overall brand strategy through Adobe's other business, which is called Adobe Experience Platform. And so Adobe has always been very consistent that to the extent that AI is disrupting the amount of software that they're selling to designers, that's going to be offset by this marketing automation business.
So there's a good concern, legitimate concern with Adobe's business in the sense that it sells its licenses by number of users.
Yes.
Right? So instead of, let's say Baskin signs up for Adobe, if me and you are using it, we're paying for two people.
Yes.
Right? And now AI is taking Ernest's job.
Yep.
So now we're only paying for one license instead of paying Adobe a flat fee. If you expect, like we do, AI to transform businesses, and maybe you'll need fewer workers to do the same exact things because the tools are better, Adobe could lose customers there. They'll have to find an offset, correct?
Well, I think I've read a lot of perspectives about this topic, and I think what a lot of people I think it's becoming a consensus today that, okay, so let's say there were two of us and now I'm out of a job because you're more productive and you can do two people's work by yourself using AI. That doesn't mean the company is just going to be like, okay, great, I'm now saving headcount from one person, right? And that's more profits for shareholders. That's not what most companies are saying. What they're saying is, wow, now I have Barry being twice as productive. So if I have two people, then I'm,
maybe I need a third.
Yeah. Maybe I need a third person because I'm that much more able to do that much more for the amount of money that I'm spending. And so I don't think it's clear at all to say that just because AI is improving efficiency, therefore there's going to be a mass layoff.
Or Adobe can position it as, okay, you had two guys using it. We're going to raise the price because you now become so reliant. We have one guy being so productive with it, one guy, one girl, whatever, that we have pricing power.
Yep.
And now you're stuck in it. So we don't think all hope is lost with Adobe. We could be wrong.
Yep.
Sometimes we are, but we're gonna trust the fundamentals. And the most important thing about long-term investing is if you get a number of them right, the upside is asymmetrical.
Yep.
Right? You can lose your investment, you can go to zero, but your upside can, if you get it right, can be hundreds, thousands %. And so when we own stocks, we want to own them for the long run. And we understand no company goes through, no company is perfect. They all go through issues, all go through narratives that change. Sometimes they change for the bad, sometimes they change for the good. I'd rather hold on to a position where the fundamentals look good and we feel like we understand what the terminal value of the future is going to look like. But anything can happen, and we've made mistakes in the past. We'll make more in the future. Sometimes we'll learn from them. Sometimes you won't, because the future is completely unknowable. Variables are completely changing. But I think the point is important in the sense that you can't abandon long-term investing strategy if you believe that the company is going to be more profitable in the future and your thesis is unchanged. And even if the thesis has changed to the detriment, if the stock has already been hurt significantly from it, maybe a lot of the bad news then is already priced in.
I think that was very well put.
I tried. So thanks so much for joining us, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.